The sheer scale of global indebtedness in the 21st century is a phenomenon that warrants careful scrutiny. The United States, as of the latest figures, carries a staggering $31.5 trillion in public debt held solely by the federal government. This colossal sum, however, represents only a fraction of the total debt burden. When we factor in the roughly $3.2 trillion in state-level debt, the $17.1 trillion owed by American households, and the substantial $24 trillion in corporate liabilities, the domestic debt landscape of the world's largest economy becomes even more daunting. Yet, the United States, despite its position as the most indebted nation, accounts for only a segment of the global debt edifice. The cumulative global debt now surpasses an astonishing $300 trillion. This figure encompasses a vast spectrum of financial obligations, ranging from the trillions held in U.S. government securities to the modest balances on individual credit cards. Every borrowed dollar, pound, euro, or yen, irrespective of its purpose, whether funding national infrastructure projects or facilitating the purchase of consumer goods, contributes to this immense total. Averaging out this global debt figure reveals a stark reality. It now stands at nearly 3 times the global gross domestic product, GDP. On an individual level, the average person alive today carries a debt burden of approximately $40,000. This is particularly concerning when juxtaposed with the average global per capita output, which hovers just above $10,000 annually. Economists and financial commentators offer a wide array of perspectives on this situation. Their opinions span the spectrum from outright dismissal of any significant risk to dire predictions of a global economic collapse. As is often the case with complex macroeconomic issues, the truth likely resides somewhere between these two extremes. Most prudent economists express concern about the current debt levels, acknowledging that while the situation might be sustainable under certain conditions, it introduces significant vulnerabilities into the global financial system. For individuals navigating this complex environment, a fundamental understanding of debt, its functions, and its distinct behavior at individual, national, and global levels is crucial. Therefore, several key questions arise. To whom is this vast sum of money owed? Can a debt load equivalent to 3 times the global GDP ever be considered sustainable? Are there responsible strategies for reducing this debt burden? And perhaps most importantly, what are the potential catastrophic consequences if we fail to manage this debt effectively? Deconstructing global debt on a global scale operates under a different set of dynamics compared to individual debt. When an individual takes out a loan, there is a clear external entity, a bank, a credit union, or another individual, that provides the funds and to whom repayment is owed. However, at the global level, there is no such external lender. Economists often humorously point to the absence of Martian banks willing to approve our loan applications to illustrate this unique characteristic. This inherent peculiarity of global debt can make it challenging to fully grasp. However, understanding this distinction is paramount. When considering global debt, it's not so much about borrowing from an external source as it is about the global economy owing money to itself. Every liability held by a government, corporation, bank, or individual simultaneously represents an asset for another entity within the global economic system. To illustrate this, imagine a simplified global balance sheet. If the total outstanding loan representing global debt stands at $300 trillion, an increase in this balance occurs when the global economy collectively spends more than it repays. While such behavior might be deemed irresponsible at an individual level, at the global level, every dollar added to this liability side of the balance sheet corresponds to an equal dollar added to an asset on the other side. Taking on more debt, therefore, is not inherently negative. In fact, it can be a powerful catalyst for economic growth if the borrowed funds are strategically deployed to invest in projects that enhance the long-term productive capacity of the global economy. When economists analyze debt at an economy-wide level, they often relate it to GDP, resulting in the widely used debt-to-GDP ratio. While a valuable metric for economists, this ratio can be easily misinterpreted and made to sound more alarming than the underlying reality. The fact that total global debt is 3 times total global GDP needs to be contextualized. Debt is a cumulative stock accumulating over time, whereas GDP is a flow, a discrete measurement of economic output within a specific year. For an individual, a debt 3 times their annual income might be excessively concerning if it comprises long-term, value-generating assets like student loans or a mortgage. A potentially more insightful measure is the comparison of global debt to global assets, akin to calculating a global net worth. While economists don't frequently employ this figure due to the complexities of accurately valuing all global assets, it offers a different perspective. In 2021, total global assets, encompassing everything from real estate and vehicles to stocks, cryptocurrencies, and the bonds and loans that constitute global debt, were estimated to be around $1 quadrillion. Subtracting the record global debt of $300 trillion yields a global net worth of approximately $700 trillion, suggesting that overall, the global economy's financial position is stronger than ever before. The significance of GDP. Economists primarily focus on GDP figures due to the inherent difficulties in accurately assessing global asset values. A family heirloom, for instance, might hold vastly different subjective values for different individuals. Determining a standardized global valuation for such diverse and often illiquid assets is a monumental challenge. Consequently, the $1 quadrillion figure likely underrepresents the true value of smaller, less liquid assets. Beyond the practical challenges of asset valuation, GDP figures provide economists with the essential information they need to analyze economic trends and formulate policy recommendations. GDP, in its simplest form, represents the total output of an economy. Theoretically, this could be calculated by summing the value of every good and service produced for the market within a given year. However, the logistical nightmare of tracking every single production line, restaurant transaction, and service rendered makes this approach infeasible. Instead, economists typically analyze spending patterns, operating on the principle that every good or service produced for the market will eventually be purchased in some form. This approach is akin to a photographer working with negatives. The data collected is the inverse of the desired image, but it allows for the construction of a detailed representation of economic activity. GDP is equivalent to total output, which, in turn, equals total market demand. This demand can be broken down into 4 key components: consumption, investment, government spending, and net exports. When analyzing the total global economy, net exports can be considered zero, as there is no external entity with whom Earth currently engages in trade. An important nuance is the treatment of unsold goods. If a business produces goods that are not immediately purchased by consumers, these goods are either classified as investment, if stored as inventory for future sale, or, somewhat counterintuitively, as consumption, if discarded. Macroeconomists, compiling GDP figures, focus on the act of production, regardless of the ultimate fate of the goods.